Hello. In this video, we'll be going through valuation allowance. Before I get into that, I want to go through the difference between financial reporting and what shows up on a corporation's income tax return. So in the financial reporting, right, on the income statement, you have your revenues and expenses equals your net income. However, for tax purposes, sometimes the revenue and expenses that are recognized on the tax return will be different than what is recognized on the financial report on the 10K. Some of those items are only temporary differences, meaning that the income or deduction that is recognized for tax just occurs in a different period than when it occurs for financial reporting. So it's not an issue as to whether an amount is taxable or deductible, but just really the timing of it, of when is it going to be taxable or when is it going to be deductible. It's not necessarily the same time as it is for financial reporting. One type of temporary difference is called deferred tax assets, and those arise when those temporary differences produce future deductible amounts. That means that in the current period, our taxable income is higher than our financial reporting income, or sometimes called book income, will be less. But that means in the future, the opposite will be true, and our taxable income will be less, while our financial reporting income for that item will be higher. So a couple of examples is when we recognize more future expenses for tax purposes, meaning that we add back on the income statement, there's an expense that we disallow for tax, but we will take it in the future. We will take that expense in the future, which means we have a future deductible amount, right? Because an expense is deductible. And sometimes that means just recognizing less revenue in the future for tax purposes. And that means that for tax, we recognize the revenue in the current period, whereas for the financial report, what I'll call books, they don't recognize that same revenue till the future. And when that happens, we can reverse that revenue because we've already recognized in the current period. So in the future, we'll have a deductible amount by having to recognize less revenue. If this is not making sense or you need a refresher, there are two separate videos. There are expense-related deferred tax assets and revenue-related deferred tax assets that you can go back and refer to, which go into each of these bullet points in detail. So what's an valuation allowance? A valuation allowance is used to reduce the carrying value of deferred tax assets if it is more likely than not that there will not be enough taxable income to utilize the tax deduction. So we record a deferred tax asset, it's called for $1,000, because we think that in the future we will get, and this is tax affected, but I'm just going to pretend it's not. We think that in the future we will have a $1,000 deduction available to us on the tax return. But we will only get that benefit of that $1,000 if we actually have positive taxable income. So if our taxable income is $5,000, and then, we set this up in year 1, and then in year 3 we get to take this deduction. So we get to take this deduction, whatever it's for, in year 3, and we say, oh, minus 1,000. So it will reduce. That's our future deductible amount. But what if in year 3 we don't have $5,000 of income? Year 3 we only have $500 of income, or we only think we might have $500. Then what happens? Then we're not getting the full benefit of this $1,000 deduction because we can only offset the deduction up to what the taxable income amount is. So that's when a valuation allowance comes into play. It reduces a deferred tax asset when the company is not confident that it will have enough future taxable income to benefit from it. And we're going to go through an example. XYZ company sells products that include a 1-year warranty. In 2027, the company estimates that the future warranty repairs related to current sales will cost $40,000, and it records this amount as a warranty expense for financial reporting purposes. So on the income statement, the journal entry was debit warranty expense, 40,000, credit warranty liability, 40,000. So on the income statement, there's a warranty expense for $40,000. However, tax rules do not permit a deduction for warranty costs until the company actually pays them. XYZ's tax rate is 25%, so the temporary difference creates a deferred tax asset. What happens is this $40,000 of expense, we add it back to taxable income, or I can say it in a different way, we disallow that expense for tax purposes. And so when we start with our pre-tax financial reporting income that includes this $40,000 expense in it, we increase our taxable income by that amount. Okay, and by doing so, we're going to create a deferred tax asset, because once that warranty costs are actually paid, then at that point, we will be able to take that as a deduction on our tax return. So again, it's just a timing difference between when that $40,000 gets to be recognized for the financial reporting income versus the taxable income. Okay, the company has recently experienced several unprofitable years and believes it is more likely than not that it will only be able to realize 70% of any deferred tax asset related to these warranty costs. So this is key right here. This statement right here, I'm going to underline, is more likely than not. That's kind of the standard. If a company thinks it's more likely than not, which is typically means more than, they think there's more than a 50% chance that a deferred tax asset will not be able to be realized, which means we won't be able to take that tax deduction in the future because we don't have enough taxable income to absorb that deduction, then you have to record a valuation allowance, which is a contra deferred tax asset account. So I'm going to repeat this sentence. The company has recently experienced several unprofitable years and believes that it's more likely than not that it would only be able to realize 70% of any deferred tax assets related to these warranty costs. Based on this information, we have to calculate the deferred tax asset, the required valuation allowance, and the net deferred tax asset that should appear on the balance sheet. So let's do item number 1, calculate the deferred tax asset. We are going to add back that $40,000 into taxable income. And so we know we have a $40,000 future deduction. So we're going to take that $40,000 and we're going to record a deferred tax asset. We're going to take the $40,000 times the enacted tax rate, and that's $10,000. So we record a deferred tax asset for $10,000. Item number 2, the valuation allowance. Well, it tells us, the problem tells us that the company will only realize 70% of the deferred tax asset, which means that they will not realize 30% of it, right? So 30% of it, they don't think they will actually generate enough taxable income in the future to be able to take the full $10,000, tax affected $10,000 deduction. Okay, they only think they're going to be able to take $7,000. So we need to create a valuation allowance for the portion of the deferred tax asset that they think will not be, they won't be able to realize the benefit from that. So that's $3,000. So you're going to take the 10,000 times 30%. Make sure you don't take the 40,000. It's the 10,000 that you base your valuation allowance against. And the way we record that is to record a valuation allowance is we're going to credit the valuation allowance. This is a contra deferred tax asset account. So its normal balance will be a credit balance. And then the entry to make a balance is a plug to income tax expense. So in this situation, we would debit income tax expense 3 million and credit valuation, not million, thousand, doesn't matter, 3. Income tax expense is 3 and credit valuation allowance 3. Now, how do we report that on the balance sheet? You show your gross deferred tax asset for your 10,000 or 10 million, less your valuation allowance, and then you have your net deferred tax asset for $7. Now, what happens if at the end of the following year, in 2028, available evidence now indicates that only 500,000 of the deferred tax asset ultimately will not be realized? We would adjust the valuation allowance to reflect the indicated amount. So now it's telling us in the following year, we have new information, or available evidence is what it's called, that says we're going to have enough taxable income in the future such that we will be able to benefit from that $10,000 or $10 million asset, deferred tax asset, except for 500,000. Whereas in the previous year, we thought that we wouldn't be able to benefit $3 million of it. So I recorded a valuation allowance, and my starting valuation allowance is 3 million. I'm sorry, I'm going back between 100,000 and millions. We're just going to continue with millions. So I recorded a valuation allowance the end of last year for 3 million, and it's a contra deferred tax asset. So its normal balance is a credit. And now we're saying the ending balance of that valuation allowance should only be 500,000. That's the amount that we don't think we are going to be able to realize. So now we have to adjust our valuation allowance, and we're going to have to debit the valuation allowance by 2.5 million. So I'm going to debit my valuation allowance for 2.5 million and credit income tax expense for 2.5 million. I want to remind you, the key to valuation allowance is this wording right here, where it says more likely than not. I cannot emphasize that enough, that this is the key. If the carrying value of a deferred tax asset is determined to be more likely than not that there will not be enough taxable income, then you will need to record a valuation allowance. Let's go to a concept check. If you want to read this whole problem, you can just pause right now, but I'm going to move forward and go and take it step by step. As of the end of 2027, Elliott had a deferred tax asset of $100,000 and believed it was more likely than not that it could realize any of the tax deductions associated with that deferred tax asset. So we're saying, so we had a $100,000 at the end of 2027, and this question asks about 2028. So we're going to go with 12/31/27 is what it tells us what our balances are, 12/31/2027. So we had a $100,000 deferred tax asset, but it was not more likely than not they could realize any tax deduction. Kind of I feel there's a lot of double negatives in this problem, but what it's saying is that of this $100,000, they didn't think that they would be able to realize the tax benefit of that at all. So they had to record a valuation allowance against it for the full amount. So if I was to look at my net deferred tax asset, I would look at my deferred tax asset is 100,000, and then I'm going to say V/A's valuation allowance was also 100,000. So my net deferred tax asset is 0. Let's take the next part of this problem. As of the end of 2028, Elliott needed to show a deferred tax asset of 150,000. So this was at the end of 2027, right? We had 100,000, but it's telling us at the end of 2028, we had $150,000 deferred tax asset. So our deferred tax asset account increased by 50,000, and we're going to start our journal entry for this problem, and that's going to be a debit to deferred tax asset for $50,000. The next part says, so the end of 2020 has a deferred tax asset of 150, and the company believed it was more likely than not that it would realize $20,000 of that deferred tax asset. So of this $150,000 deferred tax asset, they said we're only going to be able to realize or get the benefit of $20,000 of it. And so if you want to kind of think about it, the net deferred tax asset needs to be $20,000. So if I was going to look at my balance sheet, I have a deferred tax asset for $120,000, and I need my net deferred tax asset to be only $20,000. That's how much I think I'm going to realize, which means that my valuation allowance needs to be $130,000. So we started with $100,000. It needs to be $130,000. So then we need to credit the valuation allowance by $30,000. And so we're going to do that. Let's look at our journal entry now. We have our debit for deferred tax asset for $50,000, and now we've credited the valuation allowance for $30,000. The next part of the entry of the problem tells us that, sorry about that, that we assume the tax payable of that the company had a tax payable of $300,000 and no deferred tax liabilities. So we're going to add that tax payable of $300,000 into our journal entry by recording a credit to taxes payable. So we're slowly building up to see what our journal entry looks like. And then at the very end, we have all our parts. We have our taxes payable. We have, right, if we go through our 4-step process to record taxes payable and deferred for tax accounting. Step 1 is record your taxes payable. Step 2 is calculate your ending balance in your deferreds, which also includes your ending balance in your valuation allowance. Step 3 is to record the difference between those, meaning the difference between your deferred taxes and your valuation allowances. And then step 4 would be the plug to income tax expense. So the plug here would be a debit to income tax expense for $280,000. And that's what the problem was asking at the end. The end was the Elliott's 2020 tax expense journal entry includes a debit for $280,000.